Talk all about this and very much more with Meera Pandit, JP Morgan Global Market Strategist. Meera, great to have you with us. Very good morning to you. Snapshot, I guess, for me, why don't we start there on the international picture? Obviously, US markets, record highs, bounced back very strongly, but outperformed by a number of international markets. Has that changed the sort of perspective your clients have on those markets, or very much still focused on the US?
There is still a huge home bias towards U.S. stocks, but it is undeniable that there are catalysts abroad. And it's not just the weaker dollar, while that has certainly helped in many markets. If you look at the overall composition of some of these returns abroad, there's much more going on underneath the surface. And the catalysts are not all dependent on each other. So you have areas like Europe benefiting from lower rates and fiscal stimulus. You have areas like China benefiting from AI. Japan on corporate reform. Emerging markets has been a real sleeper hit even outside of China when you think about areas like Korea, Taiwan, Latin America, some of these beneficiaries from this resurgence in hardware within tech, but also from some of the reorganization of global trade. So some of these trends and catalysts, one, can continue to persist over the next couple of years, and two, don't depend on each other. If one story falls down, there's still a lot of opportunity within international.
I'm interested in terms of the big, beautiful bill, and perhaps more importantly, 9th of July and tariffs, what you think the market has already priced in. I mean, on the big, beautiful bill, is it, whether it passes today or in the next couple of weeks, is the market already expecting that it is passed? And is it a good thing for stocks, bad thing for bonds at the margin, or not? And same with 9th of July. Do you think there's if we get any extra return to higher tariffs, is that a very bad thing for the market?
I would think about the one big beautiful bill first as not necessarily good for stocks, good for bonds, but short term versus long term. I think short term, the fact that it has gone through the hoops it has with Congress and pretty much kept to the timeline that it had stated originally, that does mitigate some of the risk from the markets and some of the uncertainty. I'd say over the short term, it's likely a positive when we think about the equity markets, because you're going to see that big boost to growth coming into next year. But thereafter, we're left with the hangover of the deficit and that ever expanding deficit. If you think about the estimates that have been thrown out over the course of this bill, it's 1 trillion, 2 trillion, 3 trillion, 4 trillion. It's like these numbers don't even mean anything. So it's going to be a meaningful impact and probably create somewhat of a floor on yields over the course of time. Now, we think about tariffs. I don't want to be complacent because it felt like there was an eerie quietness and confidence coming into April 2nd. We don't want to have a repeat of that for next week. Nonetheless, it does seem like the markets have an expectation of around a 10% baseline tariff. And potentially we have to think through where some of those sectoral tariffs lie. But we went from 2% tariffs last year to 25% down to about 15%. So the market seems to have gotten comfortable around that 14 or 15% number.
So do you think that it's prudent for investors to just look through some of these risks around tariffs, around deficits? Because you've just laid them out, and yet here we are at record highs. Even the bond market has rallied nicely.
Absolutely. We have seen a mitigation of some of these downside risks. We've seen a waning of uncertainty. We've had every flavor of risk this year. Geopolitical, we've had a war that markets shrugged off. We've had this reconciliation bill when we think about deficits, the debt ceiling wrapped in there that looks to be resolving itself. We have tariffs where there's not, I wouldn't say there's an upside case there necessarily, but there is an understanding that it will impact businesses and consumers. We've seen recession risks come and go. So I do think that the path of least resistance here is higher for the market, given that we've been so resilient, and again, in every flavor of these downside risks. Doesn't mean the look forward for the economy and profits will be absolutely rosy. There are still certainly slowing elements to profit growth to consumers, but it looks like we're going to be in an okay place, and therefore for markets to be up is not unreasonable given how much we've been through this year.
With an escape velocity as we go to new all-time highs as we did yesterday, or 5% already this year, what's the second half really going to deliver in terms of the S&P 500?
We could start to be a little bit more range bound because right now a lot of it is around positioning. You've seen retail investors in March, in April, a little bit less so in May, but back in June buying. You're starting to see some of those institutional buyers bring up their equity allocations as well. In the second half of the year, I think people will still be contending with the fact that valuations are higher, so the risk reward is not attractive. But I have been struck by the market breadth this year. You're not just seeing tech run up like we have over the last couple of years. It's tech plus financials, plus utilities, plus industrials. So you have a nice market breadth here in terms of sectors. And even in the bond market, most areas of the bond market are actually doing pretty well this year. So your diversified portfolio is up 6-7% in just the first half of the year. that sets you up pretty nicely, even if we don't see too much action in the back half of the year.
Where are you on maturity for client portfolios?
I'd say still somewhat barbelled, while short duration can still protect you from some of those yield moves and get you some pretty good income. It's not a bad entry point from a duration standpoint. It feels like we kept hitting resistance around 4.5% on the 10-year when we got to the announcement of the one big beautiful bill, the debt downgrade, all within 1 week. You saw yields pick up, but then fade back down. So it seems like that is roughly the high watermark. And therefore, we could continue to see yields drift a little bit lower throughout the year, and potentially that continues to provide some opportunity for investors. Even if yields do nothing, though, that income cushion is still going to generate a pretty decent return as you move further out in the curve.
Meera, great stuff. Thanks so much.